Everyone thinks, if the government wants more money, it should just raise taxes. Sounds simple, right? But what if raising taxes could actually reduce revenue? That's the paradox behind one of the most controversial economic theories ever proposed, the Laffer Curve. And no, it's not just theoretical, it's been applied and misapplied in real-world policy. So, what exactly is the Laffer Curve? At its core, it's a way to visualize how tax rates relate to government revenue. Start at a 0% tax rate. The government gets nothing, as it collects no taxes at all. As rates rise, revenue initially increases. People are working, business is being done, and the government takes its share. But this trend doesn't continue forever. There's a tipping point. Increase taxes too much, and you start to discourage work, investment, and innovation. People may work less, hide their income, or even move their money and themselves to friendlier tax environments. In response, the base of taxable income shrinks, and government revenue starts to fall, even as tax rates go up. Instead of a straight line ascending into infinity, the relationship forms a curve, rising, peaking, and then declining. Arthur Laffer popularized this idea in the 1970s. As the story goes, during a high-level meeting with U.S. officials, he drew the curve likely on a napkin to make his point. The message was simple. You can't tax people into poverty and expect to fund prosperity. 0% yields zero revenue, but so does a 100% tax rate, because in a world where the government claims every dollar earned, nobody would bother earning anything at all. Logically, there must be a sweet spot in between. A tax rate that brings in the most revenue without stifling economic activity. But where is that optimal point? And how do you find it? That's where the debate gets heated. Real-world economies are messy, influenced by countless moving parts, and the peak of the curve isn't visible until after policies have had their effects. Let's look at some historical examples. In the 1980s, the United States, under President Ronald Reagan, cut the top income tax rate from 70% to 50%. Supporters claimed this move energized growth and kept revenues stable. Critics, however, argued that it contributed to ballooning deficits rather than fueling prosperity. Was the Laffer curve at play, or were other forces responsible? Or consider the 1960s, when President John F. Kennedy's broad-based tax reductions were quickly followed by short-term spikes in revenue. Was this thanks to the tax cuts, or was it simply the afterglow of a booming post-war economy? Such questions highlight a key idea. The elegant theory of the Laffer curve often collides with the full-throated chaos of recessions, political shifts, and unpredictable human behavior. The ongoing debates around the Laffer curve reveal something fundamental. It's impossible to know at any given moment exactly where that optimal point falls. Economic context makes a huge difference. In times of prosperity, tax cuts might indeed spur innovation and growth. In recessions, however, the same cuts could hollow out public finances just when they're most needed. Plus, some governments have wielded the Laffer curve as a justification for cutting taxes, often for the wealthy, under the assumption that doing so will always boost revenue. Spoiler alert, it does not. The reality is that tax revenue hinges on more than just the headline rate. You have to consider the elasticity of income. Do people and firms change their behavior if taxes go up? Compliance is another factor. If taxes feel excessive, will people break the rules or find loopholes to reduce their bills? And what about global mobility? In our interconnected world, money and people can sometimes flee to countries with friendlier tax regimes. Think of designing a tax system more as crafting a delicate balance. You want a system that not only collects enough revenue, but also encourages people and businesses to stay, to invest, and to grow. Punitive taxes may drive away investment or encourage tax evasion. Too little taxation, on the other hand, means crumbling infrastructure and underfunded services. So what lessons should policymakers take from the Laffer curve? It's not that taxes are inherently bad or that lowering them is always the answer. Instead, the curve serves as a reminder that taxes, like many tools, can be overused. Effective governance means being sophisticated about where money comes from and what behaviors are being encouraged or discouraged. Sometimes, lowering marginal tax rates on specific groups can actually widen the tax base, bringing previously hidden or discouraged activity out into the open. Other times, tightening loopholes or focusing on taxing unproductive speculation rather than work or innovation can yield more sustainable returns. A smart approach means asking tough questions. Are we at risk of driving away talent or capital? Could more thoughtful, targeted tax reductions foster broader economic participation? Are we taxing productivity or waste, efficiency or excess? The answers will vary, but the guiding principle remains the same: tax policy should support, not stifle, growth and prosperity. In the end, the Laffer Curve isn't a magic formula. It's a tool, a framework meant to spark smarter conversations about taxation. Understanding its lessons can help societies move past simplistic debates about more versus less taxes and toward a deeper understanding of how we foster long-term economic well-being. If we want to build better economies, we need more than catchphrases or policy by napkin. We need awareness of how taxes actually work, how they shape behavior, and where the real trade-offs lie. Raising government revenue isn't just about collecting more, it's about structuring our systems to promote growth, fairness, and opportunity for all. Too much of anything, even taxes, can backfire. Finding balance is the key. So the next time someone suggests that solving public problems is as simple as raising or slashing taxes, remember the lesson of the Laffer Curve. The real world is complex, and smart policy demands more than just easy answers.